achieves a certain level of occupancy. Okay. I mean, would you agree or disagree?
Yeah, I think a lot of times too, the small shop is tied to the opening of the major tenants.
Absolutely, because those are the ones pulling in the tenants to actually, you know, come to the space. Because those other smaller tenants aren't inherently destination sort of tenants. Okay? So that's another way that you kind of, you know, sort of look at this, is that your income, you know, is not just due purely to the lease-up revenue, but also escalations that are going to be put into place by virtue of the property being more fully occupied. Okay? All right. Other thoughts, comments, observations on this?
Are you suggesting that we could go into a bank and suggest this, or
a lending partner?
Or do they really have, like, they have their set programs that they don't do?
Most of them have a set program, especially for small to mid-sized loans. When you start getting, you know, into larger, you know, deals, there's a lot more flexibility. You know, probably above $10 million, you know, there's going to be a fair amount of additional flexibility. But those smaller loans, yeah, you're right, they're going to have their program. And that's an extremely important point to make. Their program is not necessarily the same on those smaller loans as everybody else's program.
Right.
Okay, and that's one of the things I'm trying to, you know, sort of bring out with this, is that each one of those lenders, even up to that, let's say, $10 million mark, you go to a lender A, B, C, D, and E, each one of them, you know, is probably going to have a different set of details as to what that loan is going to be about, you know, in terms of the maximum loan to value ratio, the, you know, minimum debt service coverage ratio, the what kind of tenants that they, you know, feel comfortable with versus they don't, versus what kind of origination fees or maintenance fees or whatever else it might be. You know, all of that's kind of swirling around out there. But most people are too lazy to really go and spend the time to investigate, you know, all of those, you know, maybe go to 2, maybe 3 lenders and sort of say, okay, well, I've been to 3, they all seem to be relatively the same, so I'm going to go with, you know, this one, and not be realizing there really still can be a lot of difference.
Because this type of loan they'd have to keep on their books. They couldn't sell this. Because obviously the risk...
They could sell it, it's just not as standardized. It would be, you know, one that's kind of a non-compliance kind of loan.
It seems like it's obviously less of a risk in the earlier years than it is in the later years, potentially. I mean, if your income doesn't increase. Well,
one of the risks that you run in the early years from the lender's point of view is if they don't come up with this money and you've actually got to go into foreclosure, you may, you know, it's a question of, are you going to be able to sell the property for the full value of the property in order to cash out of it and move on. Okay. But see, now on the residential side, and this is, so we'll sort of bring this back to the residential side just for a second, because it's kind of an interesting motivation. What have we talked about whenever it comes to residential loans and the residential lenders? They want to churn as many loans as they possibly can. So they want to do what? They want to qualify as many borrowers as they possibly can. Thus, the reason to why this originated on the residential side of things is because you had lenders that were saying the markets are crazy in terms of the price points of the properties, you know, interest rates are crazy, borrowers can't afford to buy houses, so let's create a program where we can still be making loans. And so thus the emergence of this particular loan product, because it still allowed the borrower to be qualified for a property that otherwise they couldn't afford. And they would probably sell off that loan to some other poor unsuspecting investor.
And then
because in one sense, here's the thing, you sort of say, well, this is all kind of wacky, crazy, whatever. Well, okay, this is really not any different, than an adjustable rate mortgage. Because with adjustable rate mortgage, you start off, in essence, with a lower initial interest rate that escalates over time, meaning your payment escalates over time.
Yeah.
okay? So it's really not that different, except the difference is, in terms of kind of on the calculation side of things, we're just sort of pre-establishing what those payment amounts are going to be for a set period of time, ultimately manifesting in the $800 a month, you know, plateau. Whereas with the adjustable rate mortgage, it's really kind of, you know, Pandora's box to a certain extent as to what you may end up with. That, you know, several years ago, what would happen is they would offer you an initial teaser rate of something ridiculously low, you know, maybe 0% or 1% or 2%, but then after 6 months or after 12 months or after a year, you know, 2 years or whatever, that teaser rate would go from whatever it is to the prevailing rate, which all automatically would make you not qualify for the loan. The way they got you to qualify for the loan was with that initial teaser rate. Does that make sense? Okay, so lenders, it's all about their motivations. If they're, part of their motivation is to make as many loans as possible, they're going to come up with creative ways to do so. I mean, already, if you've read the papers within the past, you know, couple of months, you're already beginning to see the reemergence of interest-only mortgages, you know, and virtual 100% financing on properties, on the residential side, okay? Because, you know, lenders are starting to say, woo, you know, everything is great, everything is wonderful, property values are increasing, and, you know, let's ramp up the machine again. So, keep that in mind. Okay, any other questions about this before we move on to price level adjusted mortgages? Okay, all good? Okay, this next one is kind of wacky. As if that wasn't wacky enough, it gets wackier. Okay. Any idea what a price level adjusted mortgage is?
It's probably,
Have you ever heard of it before?
it's probably tailored to some type of index.
It is. It is tailored to an index. And it's basically like a consumer price index kind of thing.
Yeah.
And here is the premise behind this loan. This is the sort of thing that the lender says, hey, the market value for properties is increasing. It's maybe relatively low right now, relative to probably what it will be in the near-term future. So, why don't I create a mortgage that, as the value of the underlying property increases, so does my payment? Okay? So this is kind of interesting. So in other words, think of it like this, conceptually. We start out with a $100,000 loan on this property. A year from now, that property is worth, let's say, $105,000. So the lender is basically saying, what we're going to do is, at the end of the year, we're going to look at this index of what your property is now theoretically worth, and we're going to readjust your monthly payment for the next year based upon the $105,000. Does that make sense? Yes or no?
Yeah.
Or we're going to increase your mortgage balance by 5%. Is what actually is happening. Okay? It's not, so you've paid off a little bit, but whatever you have left over, we're going to increase it by 5%. Okay? The next year, the property is now worth, let's say, $110,000. So effectively another 5%, if you will, or something equivalent, has been added to the balance. So now you owe effectively 110 grand.
It's like maintaining that LTV constant.
Exactly. Now you can, and you sort of say, why on earth would you as a borrower agree to something like this? One reason. What do you think it is? Not a complicated answer.
May go down.
What?
Property value may go down.
No.
Low rate.
The interest rate that they charge up front on a loan is going to be a really low interest rate, because they're saying, as the lender, we can qualify you, once again, it's all back to the qualification aspect, we can qualify you for a more expensive loan because we're going to charge you this really, really low interest rate, but we're going to make up for it because we know that the value of your property is going to escalate over time. Therefore, we're going to get really ultimately more money from you than we would have gotten, but it's a great sales pitch because I can tell you that if the prevailing market interest rates are, let's say, 7 or 8%, and I'm able to come to you and say, I'm going to give you this wonderful price level adjusted mortgage for a 3% interest rate, and yeah, your payments may increase over time, but yet the value of your property is going to increase over time, you're going to say, that sounds like a great deal to me. Do you follow?
Mm-hmm.
Okay?
Well, illicit, it's not.
You got terrible credit.
Which we established on the first day, right? Okay, so how does this work? Let's go through and kind of show the mechanics of this. All right, so we've got our loan amount, and once again, this is 12 payments per year. And we'll say this is at a 3% interest rate for 15 years. So we get our initial payment. Okay. Now, as I had mentioned, we're going to make the assumption that end of year one, we're going to have a 5% increase. End of year two, I don't know, a 3% increase. And we'll sort of leave it at there. We can obviously keep adjusting it, you know, however much we want to, but we'll sort of, to keep the problem relatively simple, we'll sort of stop there. Okay. So we do this. The first thing we've got to do is find out what is the balance of the loan at the end of that first 12 months. Okay, so we do that. Okay, so just to make sure that we are clear, at the end of that first year, that is what you now owe, okay? But based upon what you owe, the lender is saying, we're going to charge you effectively, or we're going to add 5% to your balance to price level adjust your mortgage, okay, to what the current prevailing value of your property would be. Now you're saying, well, where do they get that number and that sort of thing? And it's usually based upon some sort of a predetermined index, okay, of like a consumer price index. Now you're not going to know that up front, what that percentage is going to be, okay, let me make sure that's clear. It's the sort of thing that at the end of the year, they're simply going to look at some sort of usually a government published index that's going to say either home values or property values have risen by X% over this past year, and then they're going to simply apply that percentage to the loan. Or maybe use something like even a federal sort of like consumer price index kind of thing.
Will the index have to remain constant?
No. Well, the index that they use, yes, will remain constant in terms of it's going to be pulled from this government index, whatever that is, but the percentage will obviously change from one year to the next. It's basically it's like an inflation sort of thing, or potentially deflation.
Right. Yeah.
Okay, so all you're going to do is you're going to take that balance, multiply it by 1 plus the percentage increase, or in this case 5%. And so you, as this poor borrower, you spent this past year paying off almost, about $30,000-ish of your mortgage, only to have effectively it almost reset to what you originally started with, okay? Kind of disgusting and disturbing, but nonetheless, that's the way it works. So what we do is this now becomes our new loan amount for the remaining, how many years? 14 years, okay, because 1 year has been paid off. So what we would do for 14 years at whatever the prevailing interest rate was, which was what, 3%. Get our payment for this year. So now our payment is $725.11. Just to make, just for comparison point. So we went up from $690 to $725. So basically a $30 a month increase based on this, okay? Now we need to find out what the balance is at the end of this year. So once again, another 12 months, okay? So we start the loan over. So now we owe $93,572.21, and then at the end of that year we said it was going to increase by 3%. That kicks us back up to $96,379.38, and if we assume that from that point it stays constant, at 3% now for 13 years. And now we're up to $746.86 as the monthly payment. So once again, our original payment on this loan was $690, and now we're up to $740, so basically $55-ish of increased payments. So what do you think about this kind of loan? You don't want it, okay? Absolutely, but yet at the same time, from the lender's perspective, it's a heck of a deal because they're able to now be drawing in a much larger overall payment than what they would have been able to draw in essence, getting a much higher rate of return on their money than they would have gotten.
Theoretically, could the payment go down?
Theoretically, yes. And it, in some cases does.
Right. That might be
much the same way. And see, here's the thing. I'm presenting kind of almost in once it's the worst case scenario from the perspective of the borrower. But just like with an adjustable rate mortgage, you can have the interest rate go down if you happen to be obviously in that period of time. I mean, the very first mortgage that I got back in like 1990, I think it was, somewhere in that vicinity, interest rates were like 8.5% for home mortgages. And I had an adjustable rate mortgage and it went down to like 8.2 and 8.1 and so forth, and then went back up a little bit. But the point being is, yes, it can go down. Okay, so there is that possibility. So what do you what are your thoughts though about this kind of mortgage? And to what extent you might be able, even though this, once again, has traditionally been applied to the residential market, can you see some benefit to applying it to the commercial side?
I mean, if you're looking at more of the cash flow on the property, not so much your reversion value, you can figure, okay, well, if I'm getting enough cash flow from the property, then it might be worth it to do something like this.
Right. Well, if
you're getting
yeah, okay, let me flip it another way. Once again, and Dustin's question, earlier, about, traditional lenders have their program, and that's a good word to use because, it's kind of like they have a standard, normal approach to, a lot of their sort of loan packages. But as I have said before, don't think of all lenders as being banks. I can be a lender just as much as you can be a lender, you know, and I can structure a deal however effectively I want to, as long as the person that's working with me is willing to accept those terms. So there's nothing that really precludes me, especially on a commercial loan, to say, hey, I'm gonna, you know, loan you the money at a really low interest rate up front, but I want to be compensated proportionately to the increase in value of this property over time.
Right.
And so as this property is increasing in value, especially if I'm going to be a long-term investor in this deal, and we're not inherently going to cash out in any time soon, this is one way for me to consistently get a return that mirrors the actual value of the property itself. Does that make sense?
But on here, you can have an adjustment every year. You would have to have like some sort of like lockout, like it adjusts the first 5, because you would never, effectively, you'd never, as you get closer to the end of the 15 years, if it's adjusting every year, I mean, payments towards the end are gonna be,
It could be.
you know, astronomical.
But once again, you know, with like a traditional adjustable rate mortgage, they do adjust. Pretty much right
Here, I
until the
mean,
end.
you keep adding.
Well, no, but you could be subtracting too.
Yeah.
But once again, if the market has
Assumption
declined,
is, yeah.
the payment is declining as well.
And then
I
you
mean,
have
you're making the common sort of fallacy that real estate markets only increase.
No, but I'm saying here in this, if it were to increase 3% every single year.
Right. Your payments
the
would
later
be.
part, you'd have to pay potentially close to $100,000
Right.
off in 1 year.
Right. But another way you could also look at this could just be a portion of your deal. This could be your ground lease. But in other words, because the land value could be increasing depending on what improvements that you're placing on it. And so you could sort of say, in the beginning, this piece of land doesn't really have much value because there's nothing on it, but as you add improvements to it and you make those improvements, you know, incrementally more valuable, that's going to change, at least percentage-wise, the value of that land.
I can see how an investor.
All I'm trying to do is, once again, it's all about the creativeness of thinking, you know, how can both you on the developer side, investor side, lender side, think about these structurings that go beyond just the simple, straightforward kind of fixed rate mortgage for so many years at a fixed interest rate. While those do exist and are maybe the predominant model, there are all of these alternatives that are available that are really only limited by your creativity. And the point is that each one maybe solves a problem. It might create others, but the idea is that it may allow you to do something that otherwise you might not be able to do. Does that make sense? Because to me, this could have a lot of value if I'm a landowner, as an example. If I'm a landowner and I own this piece of dirt across the street and the only income that it's generating currently is off of the parking revenues, but yet a developer comes to me and says, well, hey, you know, we'll do this wonderful development deal with you and increase your revenues. And I'm saying, well, okay, how about doing a structure like this, that as the value of this property increases from 1 year to the next, the payment that you give to me increases as well, is all you're really saying.
It sounds like the last option where none of the other options are, a lender won't offer you any of the other options, and this is kind of, if you want to get financed perspective.
And that may be the situation that you're in. You know, so it's just another, as I sort of look at it, it's like a lot of tools in a toolbox. You know, you're not maybe going to use it all the time, but knowing that it's there, knowing that you can, you know, use it for this specified purpose, or combine it with another tool. And that's the other cool thing about this stuff, is that virtually every single one of these things can be combined into one absolutely monstrous kind of loan that almost no one understands. But yet, sometimes in that confusion is the value. As I may have mentioned, whenever I was working as a consultant with Oryx Capital Markets on CMBS loans, one of the things, they had a couple of guys on the payroll at the time, they were paying, $500,000 a year each to do nothing but interpret the complexities of some of these commercial loan documents to actually understand who gets paid, when they get paid, how much they get paid, with all these weird little preconditions and caveats that may have been thrown on there by the other side. And the whole idea is that these guys could figure out, and unwind, some of these situations to the point of how can we make money off of this? Okay, so sometimes they are purposely made complex only to confuse the borrower. I'm not saying that's ethical, moral, that's not my point, but there are plenty of instances of where the lender is simply saying, I'm going to offer you this wonderful, great loan at this really low interest rate, without really getting into the devil in the details of here are all the preconditions that you've got to meet, and here are the reporting requirements you're going to have, here are the reserve requirements, here are all these other things that potentially are going to be required. Okay? Questions? Okay. Take another 5-minute break.
Man, leave that. I wanted to ask you a question on this. You can
I'm not 100% sure that you could, because I think if you do that, you're also resetting the term.
Okay. That if you keep it in, you mean?
Yeah,
like,
right,
continuously.
right.
Okay. And then, as far as a calculator function, when does it matter? Like, I understand, positive, you get
it's really
negative.
yeah,
I know in some questions,
okay.
it will matter.
The way to keep yourself from ever screwing it up is think of it as who is paying. And if you're looking at it from the perspective of the borrower, if it's cash outflow to them, make it a negative. If it's cash inflow to them, make it a positive. But if you're looking at it from obviously the borrower or the lender's perspective, it's just flip-flopped.
Right. But in this particular situation, if you would have put a negative, it doesn't affect the numbers. But there's some times that it will
be,
not the no solution type,
right.
but it will affect.
Yeah,
I'm just wondering, when does it affect it?
It affects it when you've got like a present value, a payment, and a future value. Because with those three all in play at the same time, you've got to make sure that the present value is either paired up with the payment in the sense that both of them are negative,
Okay.
or if it's paired up with the future value, they could both be negative. It depends. That's where it gets into. You need to look at it from who is paying and who is receiving.
Because I know some of them you do get a different answer.
Yeah, absolutely.
Or a different rate, different higher.
Yeah, I tried not to
so.
do anything like that on my test, but.
No, but I was just wondering, like, as a fun, like, trying to understand how the calculator works.
I would always just look at it as if whose cash outflow it is, whose cash inflow it is, and that will always keep it straight.
Okay, all right.
As long as you look at it, and another way I just just a simple thing is like who's writing a check,
Yeah.
who's receiving a check.
And then when you're doing the lease work with the leases, that's always in the beginning.
No, I mean sometimes it's in the problems it is, but it doesn't have to be that way at all.
Okay.
Unless it sort of specifically states that it needs to be that way.
But isn't a lease you're paying for the use, and then
You are,
interest
but
you're
as I-
getting the use and then paying?
As I said, that normally you don't recognize that income until the end of the period.
Okay. So unless it specifically
Says to make it at the beginning.
at the beginning? Okay.
I would argue that very seldom do you ever use the begin mode unless
It says it.
you need it.
Unless Forky says so. Just going over some of my notes and stuff.
Yeah.
Trying to keep it all together.
First question was number one. Okay, so you assume that you're in a
No, with net present value, solving for net present value, is that only when you're doing cash flows?
Yes.
As far as deciding to use net present value or to solve for net present value as against present value or future value? It's cash flows that you
Yeah, well, I mean, with the present value on the calculator, you make the assumption that any sort of payments that you're either making or that you're receiving are going to be constant payments. They're going to be like annuity payments. Whereas with net present value, the beauty of the cash flow thing is allows you to then have those payments that are different.
So once the payments are variable, then we can start talking about net present value.
Yes,
Or net future value.
yes.
Wait, are you reading here?
that gives you.
Yeah. Sometimes the year, you divide, multiply.
Alright, so you got $1 million, this thing costs $1 million, you're gonna make.
Maybe double. Right.
Do you have the answer for this one? I could give you a different answer.
Based on written calculus, and year 46 and
Yeah.
Well, it kind of is because you're you assume
No, I wrote this down, but I didn't get it. I don't know why.
Well, I
So you
wrote
have
down
your
the 10%
now, when you apply the same rate, we're saying, if I use all cash, I can make.
Also, you gave this the present
If I give
value.
you this
And then,
take this 9%, 10 of the
but then there's the whole 10 years. Okay, that's what Oh, because this is like a net future value question.
It is, because none of this is risk adjusted.
I was thinking like logically, I was thinking like for the next 5 years, you calculated then, but you gotta do it for the
That's
whole
what I
10
thought originally, but you still calculated it for the whole time right up front.
Okay, that makes sense.
That would be only if, all right, at this particular time, then I want to see what is it worth going forward.
You are minus the salvage value. Right. So you can sell it for something less than what it's worth.
Like, what is the value below market rate?
Less than 10%.
Finance.
Finance. Then your yeah, your return on equity is already 5. But it's not a 1%.
Do we have a guest speaker later today?
That 1% spread.
Not today.
Could be
Nope.
REE, 15%.
Those will start in another week or two.
So So then you can use your other equity to get more of those 15%
Oh, I didn't know that.
So,
That's the one question.
Right. Yeah.
Okay, so,
Me and Laura are comparing my cancers, and but I got this. So I'm not sure.
I'm gonna spend about 30 minutes on it.
Oh, yes.
I mean,
Oh, wait, oh, so this is gonna be
no, it's gonna be a test, but we're gonna spend like from 11 to 11:30
Oh, yeah.
today with a question and answer session.
Yeah, that's right.
probably closer to 8 because you take it down. That number.
It's a goal.
Calculate.
Yo, did you have that light fast forward button?
Dashboard.
Oh yeah, I got the click remote.
You got that easy button.
But the way you should be looking at that is, I gave you a whole bunch of other problems you did have answers to.
Well, the chapter 4 ones we had all the answers to, but then like I went through the class examples again, and then I wrote them out and did them myself. But there were a lot less examples of the more difficult questions that were like say out examples and videos. That it was like when I got to this, I was like, well, I think I'm doing it right, but if I'm not, I really don't know. You know.
Can we ask you a couple questions on here?
No, I mean, wait, 11 o'clock.
Got a half hour to get every answer you need.
Yeah, just a simple box.
Well, I've always found that if you have the answer in front of you, when you're trying to do something like that, you have a tendency to cheat.
I almost think that it's like I went through it and at first I was like, oh, this sucks that we don't have the answers. And then I was like, you know what, it's for myself. But then at the end of the day, it's like I almost switched it like yesterday at 12 o'clock. I'd been given the answer just to see if at that point I had done them all right or which ones I should theoretically go and redo.
The one thing I would say from some of the videos, the ones where by the time you cut to it, all the answers were already on the sheet. I hated those, because then I had the propensity to look like, wait, am I going in the right direction? I'd rather you work through them as you talk. I know it saves you time, but...
See, I only watched the videos after I attempted to do it myself, and then when I couldn't figure it out, I watched the whole thing, and then I redid all the questions like the next day.
Yeah, I waited till I got good at it to start doing them on my own.
I mean, it didn't work the first time around. It just got me to try it. I tried.
Well, I mean, it's the way I see it to a lot of people. I mean, these are things you can't memorize. These are things. It's a process that after you kind of have gone through enough of them, it begins to kind of the synapses in your brain are firing to the point of where it all begins to kind of, the light bulb goes on, you made the connection, and now it all makes sense.
No, I would agree. I mean, I didn't even have to watch the video of some of them because you realize that it's the same as I've done before.
Okay, let's get started. All right, take a look at this question. What is the value of below market rate financing? Now,
As a lender?
as a borrower. So, for example, let's say that you're coming in as a borrower wanting to purchase a property. I currently own the property, but yet I have a loan on the property. And maybe I secured that loan on the property a few years ago at an interest rate that was dramatically less than today's market interest rate. Okay, now what could be the value to you as the new purchaser of assuming that loan? Like, now, for you right now, you're saying, well, that scenario really doesn't exist because right now we're still at pretty much almost an all-time low for interest rates. Yes? But don't you expect that 5 years from now, there's probably a pretty good chance that interest rates are going to be higher than what they are now? We would think they're probably going to be higher than what they are now. Maybe they're not, but we would expect that they're going to be substantially higher. So if today I've been able to, I've gotten an interest rate of, 4% on my property, but yet 5 years from now, the best interest rate that I might be able to get is, I don't know, 8%. What is the value if I can transfer my loan to you? You follow what I'm asking? Okay? That I am the owner of the property, you are a prospective purchaser of my property. You come in and you say, okay, I want to buy your property, and I say, okay, I've got this $100,000 loan on this property that I have a 4% interest rate on, and I'm willing to sell it to you, and I'm actually willing to transfer my loan to you, versus you saying, I'm going to go out there and I'm going to get a traditional loan in the prevailing market that's 8%. All right? You would hope that you would take seriously the value of my 4% loan as opposed to paying 8%. Because let's just do the math. To keep things simple, once again, $100,000 loan, currently 4% interest rate for 15 years, let's say, versus, even though you may have paid down some loan, we're just going to keep it at $100,000 to keep the math simple. The prevailing rate is 8%. Okay, so take a look at those. And once you get them, figure out what the difference is between them.
Are you assuming that the it's an assumable loan?
Yeah, we are, and we're going to talk about that as well. Okay. So everybody understand what we've done, okay? We have a loan that I currently possess, $100,000 loan. Interest rate that I have is at 4% for a 15-year term. My payments are $739.69. Robert's come along, wants to buy my property. I tell him that I will transfer my loan to him, but I'm not going to do so for free. That's the key, okay? I'm going to charge you something for that transference. Mm-hmm. Because your alternative, your only other alternative, is to go to a new lender and get a new loan at the prevailing market interest rate of 8%, meaning your payments are now going to be this. Mm-hmm. The difference between the two on a monthly basis is $215.96. Does everybody see that?
Yeah.
Okay. And everyone would agree that's a substantial difference.
Yeah.
Now, the simplest might be, Robert and I just come to a simple agreement that we split the difference. We kind of say, in other words, he doesn't want to maybe pay the whole $215. I mean, because why would he? Why would he want to pay the entire $215 to me? Because that would be the equivalent of just getting a brand new loan. Yes? Yeah. Now, there could be some value to him doing that. Of basically paying me the full $215.96. We can talk about those for just a second. Why might you do that? Because you would potentially get out of a whole bunch of closing costs. Mm-hmm. You wouldn't necessarily have to do an appraisal, have to do a whole bunch of inspections, have to do a bunch of title-related sorts of things, because technically I'm now, in one sense, the lender, or I could be, depending on, once again, how the deal is structured. If I'm actually transferring the loan to him, or I am merely collecting his payments while I am still servicing the original mortgage. And under that situation, I could not transfer title to him until he has made, or I have made, really my final payments on the original mortgage. Does that make sense?
Yeah.
So a lot of different little scenarios going on here, but bypassing all of that, there is some value to you just simply assuming, or me allowing you to assume my mortgage or to take over my payments or whatever we want to call it. And at minimum, or at maximum, the value is the $215.96 monetarily. But there could be other non-financial things, as we were saying, in terms of closing costs and other, fees that you might incur, by getting the more traditional loan. Okay, so I want to sort of start the discussion there and then kind of go from there as to what maybe the full value is of this over the course of the loan. Okay, but before I do that, I just want to, any questions or just sort of thoughts or any interesting insights? Nothing? Okay. Let's take this number for a moment and just do the simple math. The simple math being, we're potentially saving Robert $215.96 over 180 months because it's a 15-year loan. So in terms of just out-of-pocket costs, $38,873.18. Does everybody see that? Yes, no? Okay, once again, we would all agree that's pretty substantial. So the question is, once again, we might ask the original question, what is the value of that below market financing to Robert at maximum, just on a financial terms? It's this in terms of raw cash flow, but we're probably not going to base it really, in other words, you're not going to write me a check right now for $38,000, right? No. What you're probably going to do, you could do, is you could maybe write me a check for a portion of that, okay? But, how much is maybe an appropriate portion to actually, write it for? Well, what we could do is to discount it at, but this is, let's just do it this way. We say for 15 years at the 4% interest rate, and actually what we're going to do is take the 215, so take the 215.96 as the payment amount, and then solve for the present value. Yeah.
Minus 215?
Yeah, you could either way. It's just going to flip flop it depending on which way you put it in. So if you put in this positive 215, it'll make it negative 29, 196, 09, or 10. Okay. So it's saying that basically the present value of this in today's dollars, based upon the 4% discount rate, that $38,000 is really worth about 30 grand today up front. Okay, Dustin.
2 questions. Is it 4%? Is that the difference between the two interest rates, or are you
No.
taking no?
It's the current prevailing, or not the current prevailing, the assumable loan interest rate.
Why would you use that one? Wouldn't you use the 8% if that was the opportunity cost of?
You could, but this is going to be a more conservative number.
And you wouldn't want to take the difference between the two as?
Well, you're already doing that whenever you're calculating the payment.
Okay.
You're already doing that. So the point, okay. So the point is, once again, at maximum, this is how much you would potentially be willing to pay upfront for the ability to assume my loan. Okay, the discounted value. okay? And now, the question is how that might, like for example, assuming you don't have $29,000, what you would effectively do is maybe go out, get a loan for something less than that, and potentially then pay back that loan while you're also paying me the monthly mortgage payments. Okay? All this is really trying to do, and you know, all other things aside, let's get back to the original question. What is the value of that below market financing to you? And at minimum, you know, or maximum in terms of the monthly value is $215 a month. But yet if we discount that, we're saying it's worth about 29 grand. Okay? Does that make sense, everybody?
Yeah.
Now, another way of looking at this is flip it another way. This can almost, or not almost, this could also be a way you look at refinancing. What if the current prevailing rates are 8%, or maybe your current mortgage is 8%, but yet now you're able to get a 4% loan by virtue of a change in the market, rates have gone down, how much potentially is it worth you refinancing? Flipping it the other direction. In other words, how much money are you going to be saving effectively by refinancing the loan? Because one of the things that, you know, historically a lot of borrowers, when it comes to on the refinancing question, is a lot of borrowers, sadly, every single time the interest rate drops just a little bit, they're rushing to the bank to refinance, you know, their property. But in most cases, it really doesn't do them that much good unless, once again, they're going to stay in that property for an extended period of time. And usually the cost of that refinancing is usually not free. So, you know, you have to sort of begin to kind of add those things in as well. But for the purposes of this is really looking at what is the value of an assumable mortgage, is basically what it boils down to. Most loans are not inherently assumable, but yet, in one sense, they kind of are, for commercial loans. And what I mean by that is, depending on the ownership structure that you have set up for that commercial loan, can dictate to what extent it is sort of assumable. Like for example, if I have started up XYZ Corporation, and I have so many shares of stock in that corporation, I currently, let's say, own 100% of those shares. Very little precludes me from selling those shares to Mark. Therefore, Mark takes on whatever responsibilities that XYZ Corporation had, which might happen to be a real estate loan with a lower interest rate. You follow?
Yeah.
Does that make sense? So that's one way that effectively you can basically assume the loan, because most of those commercial loans are going to be based upon the faith and credit of the actual corporation or the actual tenants that are occupying the property. Justin and then Ryan.
So on this question up here, if you were comparing it to a 30-year, a 15 and a 30-year, would you just find your future value?
Well,
of both those at that time?
You would probably segment it into two separate problems. You would find just the value benefit from the 15 years worth of savings, because you would not necessarily have those savings for the entire 30 years.
Yeah. Then you add them together.
Because I mean, like, if you're going to use this for comparing if you should refinance or not, because you know, this one you're comparing apples to apples, like,
Right.
But it's
It does get a lot more complicated in terms of trying, but ultimately, at the end of the day, this is the approach that you're going to take, of just simply looking at what is the difference between the 2 monthly payments and then finding what the present value difference is, or the present value amount would be upfront for that cost savings. Because like with most, you know, as I said, with most refinancings, if you're only going to hold the property for another couple of years, you're only getting a couple of years worth of benefit out of it. So you're saving yourself maybe just a couple $100 a month for 2 years. Well, that's maybe not worth that much. Right.
Okay, so the answer to what is the value of financing is, in pure cash terms, is the difference between payments
Yep.
times the
Yep.
number of payments that
Yep.
that difference applies.
Yep.
If you were to pay it all, or what's the value of this all up front?
Yep.
It's the present value.
Yep.
What determines what rate you discount?
Normally, in this particular instance, we're going to be using the more conservative of the two, the lower rate, to come up with the value. Because what that's going to do is actually it's going to give us a higher overall number for the present value. The higher discount rate would give us a lower number, but this is going to, and so it's more from the standpoint of this. It depends on, once again, whose perspective you're also looking at it from. If you're looking at it from my perspective as the seller of the property, I'm trying to maximize the value that I can extract from the potential purchaser. Robert may actually want to use the 8% to come up with his value, and then ultimately maybe do something in between.
So I guess my question is why are either one of them appropriate? Maybe you want to use like a long-term forecast of CPI
You could.
and say,
No, theoretically you could. It's more of you're just trying to operationalize it in some way to come up with a number, and it's not an absolute. It's a question, because it's dependent literally upon your level of sophistication. At the most base level, that's what I'm saying. You're just looking at the cash difference of cash out of pocket. But if we're trying to sort of equate this to our opportunity cost and that sort of thing, then we're going to need to potentially discount that number, by some amount.
You can use any number of ways.
Potentially, yeah, absolutely.
But you would think it would be the 8% because that's the prevailing
Well,
rate. That would be the-
for Robert, he would probably use that rate. For me, as a seller, I'm probably going to use the 4%. And then we're probably going to come meet in the middle.
Didn't you say the lower the rate, the higher the present
Correct.
present value?
It's a cap rate.
Right. So in other words,
Maybe like
it's
the other way
more from the lower this rate,
Right.
like here, if we were to change this to 8%. This number, the present value number, should be less.
It's 22,000.
Well, I'm just gonna, well,
22,590 if you want the exact.
Because that number there, when you take that money, you can put it somewhere to get 8% at today's rate.
that's what I'm saying. It's a question of whose perspective are you looking at it from. I'm saying from my perspective as the seller, this is probably what I'm going to use.
Okay.
Robert's perspective as the purchaser,
Right.
that's the perspective he's going to use.
Right.
Because this is what it's worth to me.
Right. And we may end up having to meet somewhere in the middle. Okay? And it's just, once again, it's not an absolute. At least not in my mind, it's not an absolute. It's a question of negotiation of,
Right.
Because once again, I get back to why would he pay the full discounted value if he's not getting anything else for it, other than those, as we sort of said, those marginal benefits of potentially reduced transaction cost and closing cost, sort of thing. So I, in one sense, should be kind of sort of happy that I would get something at all. Because in one sense, Robert could just go ahead and walk down the street and get the new loan. I'm trying to help the guy out. Sort of look at it from this perspective. I'm trying to help the guy out. And if he'll offer me, I don't know, 10 grand up front, on top of what he's paying for the property, that's a heck of a deal for me, theoretically. Now, this is where it begins to be interesting. Okay, now that you hopefully understand conceptually what we've just sort of gone through, let's say that I am able to, I'm a developer, and I am able to consistently offer my home purchasers or my condo purchasers or my whatever purchasers below market financing, think about what I potentially could do. I could, in essence, set a price point higher than normal market value. Now you begin to connect the dots.
Yeah.
Okay, that I could set potentially a higher price point for the property than otherwise might be achievable. So that for this property, that we're saying was worth 100 grand, with that below market financing, theoretically, I could be charging Robert, because of the below market financing, I could be charging you close to maybe 130 grand.
Because of the value.
Because of the value of that below market financing. Well, that's a 30% increase over what the value is. So my point then is, if I'm a home builder, condo developer, some other, sort of individual, especially where you have unit sales of some sort, the first thing you want to do out of the gate is you want to set your price point as high as possible. Yes? Yes. Okay. One way to achieve that is if you're able to offer something up front, especially to the first few purchasers, to establish that price point at a higher value. Okay? Now, the devil is in the details as to what subsequently happens to that. Because if a really good appraiser figures out what you've done, they're going to see right through that, and they're going to say, well, I'm going to subtract that money off of the market value because effectively you're inflating the value of your property because you're offering this below market financing. You follow? Yeah. Okay, because you're offering something of more value than what it really is worth. I mean, it's the same sort of thing that, once again, for those first few purchasers, what might a developer do on like a home building or a condo thing? They might throw in, I don't know, all of the appliances and maybe some upgrades and other things that maybe they don't offer to the subsequent purchasers because, once again, they're trying to establish that initial price point up here as opposed to here.
Right.
Okay, what do you think about that?
It's nice. But it'll really only benefit like if it is a if it's a long term sort of purchase, like if on the purchaser side, it'll only really benefit them if it's a long term purchase, right?
Yeah.
Yeah.
But at the same time, think about how price, and my whole point with this is think about how price points are set. They're set by the first few sales.
Right.
Okay? And the last thing that you want to do is have your initial price point set down here, and then you are trying to then get the future sales up here, because it goes against normal logic. Normal logic would dictate what? Those first few sales, we sell at a big discount to get them sold.
Right.
Then, all of a sudden, once everything is done, everything is whatever, then we escalate the prices up here. But the problem with that, unless they're cash sales and that sort of thing, the problem with that is the price point has been established here, and it's difficult to sometimes get that escalation. Versus if you're able, by virtue of once again, some other incentive to set the price point up here, and then maybe have it potentially gravitate, if it has to, downward, or at least stay the same, or potentially migrate upward over time.
So basically, you have below market financing with appraisers that are asleep at the wheel, and that's what could
Absolutely.
Extreme overinflation of property values.
Absolutely. Because they're just looking at it maybe on a price per square foot basis, and they sort of said, well, your price point, because your product happens to be unique enough that it's, it maybe doesn't have enough comparable sales in the area or whatever it might be to really establish it, legitimately at any absolute level. And so, it's one way that may exist for, that property to be inflated in value.
How would the appraiser ever know?
Well, it depends on how much information they have available to them. This is why, and I'm not advocating this. This is not what I am, this is not what I am doing. I'm simply making you aware of this. Because what I have seen with a number of, especially with condo developers, is that in some cases, those first few sales, they will actually keep private to avoid the impact on the price point. That those first few sales, they will say to the consumer, you cannot disclose what you have purchased this property for to the general market and not make this information available on the MLS, so it is totally.
What about the deed and all the registering documents?
Once again, the only thing that would give it away is potentially the mortgage deed or the promissory note that would have a loan amount attached in there, but not necessarily the price.
Get back into it though, right?
Well, only if you know what the deposit amount was. But you could, argue that the deposit was higher than normal.
Could you use the tax rate back into it?
Well, even the tax may not give, and once again, it may only give you the tax value, not necessarily the actual transaction value. Now, my assumption is, I know in Texas it's not a full disclosure state. And so you can basically hide that information completely. Now, Florida may have more disclosure, but typically, my understanding would be that it's only going to be what you report.
Gotcha.
And now, certain states are full disclosure states in that you have like stamp duties and other things that may apply, and those, you are going to have to maybe base it on the actual transaction value.
Isn't there a deed, it says something about at the concession of like $10 or something like that?
Yeah, and so a lot of times the deed will just simply say, in due consideration of $10, and so the dollar amount is not placed in there. Now in the promissory note, which is the loan agreement, if that is a agreement that is made public, that only gives, once again, the dollar amount of the loan and the interest rate on the loan, that sort of thing, doesn't tell you what the down payment was, which once again will keep that information from being fully available. But my point, getting back to what I was trying to say, is that you will have a lot of these condo developers that will say, you are not allowed to disclose, what you paid for this condo for 6 months, a year, whatever, and their whole reason for doing that is to establish, a price point that is usually going to be greater than what the dollar amount was they sold those first few units for, because you don't want that situation of, well, I know you got a price at $100,000. Why am I paying $130,000? Kind of thing.
How will it work as far as, because obviously for you to offer that below market financing, you had to secure that financing first, right? And so,
or you have simply worked out an arrangement to where you're subsidizing it.
okay,
That you're basically only subsidizing the difference up front just to secure the deal
okay,
for roughly maybe a short period of time. Maybe you're subsidizing the rate for the first couple of years or the first 5 years or something like that. Okay?
But you could look at this strictly as you're the commercial property owner and you want to, instead of sell outright, you're going to owner finance it to the new buyer
Yes.
at a below rate.
Yep.
And payment affordable, with the balloon, I'm talking like 5-6 years and
Absolutely.
clean house
Because,
on it.
I mean, any of you that, if you've gone through a residential purchase, you know how much brain damage that is, okay? And how much paper and everything is involved just in that. And then the commercial is no different, and in many cases it can be equally as bad, if not worse. And, there is value into you being able to find a property owner that owns the property free and clear, or has a mortgage that once again, they are willing to allow you to sort of piggyback off of and avoid all the brain damage associated with getting that, or you maybe don't have the credit yet to support it. This is one way to potentially jump into it. I'm not advocating, saying it is an option. Okay. Okay, other questions? Good. Okay, let's work one or two more little things, and then we'll, a quick break, and we'll come back, and it'll be time for the sort of review for the test, and then the test. All right. One of the things that we need to talk about a little bit, we briefly mentioned some of the characteristics of, but I want to kind of go through some of the details. Construction loans. After we finish the construction loans, like I said, we'll take a break and then we'll come back and do the review. Okay. So what are the characteristics of construction loans? Short term. Usually a higher interest rate than the permanent financing. They're set up more as a line of credit. Based on construction cost, projected construction cost. You effectively draw down dollars based on cost incurred. And usually you have some sort of an agreement up front for what is referred to as a takeout commitment. And this is, once again, referring more on the commercial side of things than the residential side, the last piece especially. Okay. So any general sort of comments before we kind of go into the actual calculation stuff on the construction loans?
I assume a takeout means you'll take out at least 10%. Or
No.
what does it mean?
Takeout commitment is your commitment for permanent financing.
Oh,
Okay? What is going to take the construction lender out of the deal? Okay? So it's a commitment for permanent financing.
So it's basically to roll this loan
Yes.
into another one.
Yes. Because the construction lender may not be the same lender as the permanent lender. And historically, most of them have not been. More recently, you have some that do both. But if we sort of, once again, kind of talk historically, you would have the construction lender, which is normally a local lender. They're familiar with the market, familiar with the builders, familiar with the tradespeople, that sort of thing. And they do these loans on a regular, ongoing basis. They're going to be sending, people out into the field to investigate the work is being done in a timely manner, and will have the skill sets necessarily appropriate for that. And then once they're sort of done, with being the sort of construction lender, they want to ensure that once the construction meets certain thresholds, like the construction is complete and the property has been pre-leased up to a certain percentage, then a permanent lender has agreed to take out the construction lender out of the deal and insert themselves into becoming the permanent financing for the project. Okay? Does anyone want to either add or offer any other sort of insights to that? Yeah.
Well, one of the things that I know, Mark, when we were doing our the project that we're struggling with is recognizing, because you don't really pay, right? You're not paying like a monthly interest on this. You are. It's not coming out of your pocket.
It doesn't have to be, and that's
coming
also
out of the back. So
Yeah.
I get, you just recognize it as like an interest reserve in the front.
yeah. That normally, every construction loan is different, just as much as every other sort of loan is different. But a lot of them will be where you do not have to pay back the lender any of the interest on the construction loan until the project is complete.
Right, like they'll only lend 80% because the 20% are interest on the back.
Right. And so at the very end of the project, once the project is complete, the take-up commitment has been put into place, at that point, the permanent lender will in essence write the construction lender a check, or through you possibly, but ultimately they would get sort of taken out of the deal with that check. And as you're saying, that a lot of times the construction lender is only lending maybe up to 80% of the actual value of the project. But you know, hopefully what happens within the construction process is value creation, in that your total construction budget may be $8 million, but yet at the time of completion of the project, once the project is ready, open for occupancy, the value of the project is not just 8 million, it's maybe actually 10 million. And so it's very possible that, well, depending on, once again, you know, the lenders involved, that you could be potentially taken out not only at the $8 million level, but potentially at the $10 million level. Okay?
But if you go for a construction loan and it's an $8 million construction cost,
Yep.
you go for a loan of like
So-
9 million.
Right.
So you have the $1 million to cover, and then what, you just have to put some in, like an interest, they require like an interest reserve if the project takes a little bit longer, or?
Well, you're gonna come out of pocket at some point for carrying cost beyond whatever the construction lender has allowed. In other words, if the construction lender has said sort of it's like a drop dead sort of thing, we've set up a construction schedule for 12 months, we will allow you to continue this construction loan for another 3 months, but then after that, payments are going to start coming due, and you're going to be, unless you make those payments, you're going to be considered in default, or something like that. Because normally what's going to happen is you're going to have the take-up commitment in place, and the moment, as I said, you complete construction, and hopefully by the time you complete construction, you're pre-leased to meet the sufficiency level of the permanent financing, that at that moment, they take you out of the deal. But if it takes you an extra month or two, then that's where, you know, that provision kind of allows for a little bit of flexibility. But you know, once again, every lender's different. Okay.
Just to be clear, with as far as their interest, let's say that
it only accumulates on, it's like a credit card.
Right.
So it only accumulates on the amount that you have withdrawn to pay your contractors. And so it's the sort of thing that,
and you're saying it's paid at the end.
yes. So that, as an example, you know, you start out with a, like here at basically month 1, you have a balance of 0, and by the end of month 1, maybe you've paid out $10,000 to your folks, and you make the assumption that payment occurs at the end of the month. So in month 2, you start off with a balance of $10,000, and then you've got to pay whatever interest costs on that $10,000. Then, in addition to the $10,000 and the interest cost, then you've also, or maybe doing another drawdown of expenses. So now you owe the $10,000 plus interest plus the new balance, and that just keeps accumulating month after month after month until the end of the construction period, which may be 12 months, and then ultimately at the end, everything gets paid. And I think on your Dropbox, just double check.
But when you set this up in a cash flow to get your IRR, how are you supposed to recognize the interest as a lump sum at the end?
Yes.
Or
Because that is when the payment occurs. The payment occurs. You don't make payments on most of these loans until the very end.
But I know like an Argus, you break it out in like an S curve, and they.
Well, no, that's more on the expenses side. The S curve thing is more basically saying that your draws from one month to the next are not a fixed amount. it's that, certain level of work kind of
Okay.
occurs, there's a heavy amount of work that occurs, and then maybe not so much, and then maybe a whole bunch more,
Right.
it's lumpy, I guess, for lack of better
So I
description.
guess they're just using that to calculate what your interest would be based on an S curve at the end.
Right.
Okay.
Let me just double check here, but I think in your Dropbox, yep, okay. So in the Dropbox, there is a file that is labeled construction loan schedule. Looks interesting. Okay. Oh, there we go. Okay, so once again, this is in your Dropbox, but this just illustrates it. Kind of, so I've set up the interest rate on the construction loan to be 12%. As we're sort of saying, you start off with your project cost of being $0. So therefore, during that first initial sort of time period, you have no construction interest, no loan balance, no interest has been made, no principal has been reduced, and your ending balance is still 0. During this next month, okay, you have a loan draw, in this case, project cost of 1.5 million that occurs, so that increases your balance. And then the interest doesn't start until the following month on that amount. And then as you begin to then add these additional sort of draws from month to month, then ultimately your balance is just getting incrementally larger. But at the end of all of this, the idea is this is the total amount of the construction cost, this is the total amount of the accumulated interest, and then ultimately the total amount that you would owe the construction lender at the end of all this is about $9 million. Does that make sense?
Yeah.
Okay. But that ultimately is now you can, and that was when I set this up, was I also include a column here that if, for whatever reason, like partial sales, might be an example, that if you're able to sell off bits and pieces, maybe you finish certain pieces early, or maybe you sell off bits of land or something like that, then you potentially could pay off some of that balance early, therefore not having to deal with that full 12%, as the interest. And now the question that, once again, a lot of people ask is, well, why is the interest rate so much higher for the construction loan than the permanent loan? Is because of all the work that lender has to do in terms of the actual field, sort of site visits, and the risk associated with, well, what if there's a major problem during the construction process, or whatever that occurs. So usually the construction lenders are going to be very well compensated to sort of deal with that sort of issue. Dustin?
In the book, on the when you set up your cash flows for staging the development costs, I didn't understand it. It has a line item there that says average draw, and it says like 65%.
That's only, once again, if you try to set it up like once again, kind of on almost like a predetermined sort of schedule as opposed to actual cost, what they're trying to do is mimic what may actually be occurring in terms of the draws over time, and it's only going to be with experience that you're going to know. Like as a home builder, you would know how much money you're going to be spending on each component piece as it occurs, when it's going to occur in the process, realizing that certain tradespeople are all going to overlap at one particular point in time, and then there's maybe only going to be one trades person that's going to be able to work at one given time, those kinds of things. And so what like this is showing clearly is that for these first 4 months, the overwhelming majority of your costs are being incurred then. And I'm not saying it's realistic, I'm just saying that's what's happening here. And maybe we can sort of say this is a ton of extra maybe site preparation work and infrastructure work that's going into the property. and then from that point forward, for whatever reason, it's consistent, but it doesn't have to be.
Well, what does that mean when it says average draw 65%?
Well, for that particular period of time, it may be 65% of the total. In other words, if you have a $10 million loan, it would be saying that $6.5 million would be drawn within that period,
For what, just the first year?
or whatever period that they're talking over.
Okay.
Okay? Make sense? Okay. Now, what we're going to do, obviously, we'll be kind of picking this back up again later, but I just wanted to at least kind of introduce it to you and introduce the concept to you. But in terms of using it on Excel, what I am obviously, not going to have you do is, do 12 months by hand, because obviously it would be a nightmare. But, maybe have you understand it enough from a test perspective to where you would be able to maybe calculate what the balance might be at the end of the second month or something like that. Okay? Make sense? Just so that you understand the mechanics of what do you need to add, subtract, multiply, and divide.
All right.
Okay? All good? All right, let's do this. Take another couple-minute break, and then we're going to come back and then start with questions about the that you've got about certain problems or whatever as it relates to the test. And then we will starting the test precisely at 11:30.
That popped like 4 minutes fast. That's when I came in, my phone said it was 8 o'clock and yours said it was 8 o'clock.
No, I see 11:03. What the iPhone says.
Because I was trying to figure this out when we're done this project, and I still don't get it. So it says here average draw. So does that mean for the life of the construction loan?
No, it's okay. Average occupancy.
No, no.
Oh.
Current construction period.
Oh, okay.
So they get the interest. Here's the loan amount.
Oh, they're probably just saying that over the entire period that you're sort of making, you're sort of saying on average that, like, if you were to kind of take an average of all of the column for the construction cost, that add all those up and then it's like saying that you owe 65% of the balance over the entire period.
Okay, I got you. Like from day one you owe 65.
Yeah.
And at the end of the
Right.
at the end you owe 65.
Right.
Because it's just kind of okay. I was looking at it as that's all they took total, and the balance was the interest.
Mm.
The accumulated interest, but that's not the case. It's okay. This is a good book.
Yeah, I know.
And I read this thing. I didn't intend to read it, but I started and I was like, this is really good. It's a really good book.
This brings me back to undergraduate finance when I
Yeah.
had to do
Well, unfortunately, unfortunately, I don't know. It's like there's not that much difference between. Finance is finance.
Yeah.
Well,
Different
no,
calculator.
It was just, no, it was the same calculator. In fact, I gave it to someone and then I was like, who did I give it to? Now I gotta buy another one.
You're thinking, thank God this class is over. I'm never gonna have to do this
No,
again.
I took undergraduate finance after I'd already switched my major, and it was the only class I needed left to get a business minor. So I was just like, well, I'm not gonna not do it. So I did it, and I took it over the summer, which was the hardest one to take at UF. The curve on UF finance class, I think my average score on the test, I know people whose average score on the test were like 40% and they got B pluses. That's disgusting. Like, their goal is to make it so that you can get 12 questions right on the test.
Yeah.
And you have to pass the class. And it's 100 questions test. It's really.
Hey, I like curves, man.
Yeah, but do you know how you have to study for a week straight all day to get 12? Because they have every different complexity in every single question. There is no such thing as a simple question.
No, but part of it, it's just like, even with this test, what you're gonna find is, there are certain questions
Oh, of course.
that are purposely set up to be super simple.
Yeah.
And then there are a handful of questions that are purposely set up to be,
Have a lot
hit you
of
with a
different-
They're all simple, they just get complicated
When you
because
add up all
when you have to
the
add it all up, it's like,
No.
and you just gotta make sure you follow all the
Well,
steps.
it's my way of being able to determine, okay, who doesn't know it at all, who kind of sort of knows it, who knows it somewhat with a couple of little curves, and who really knocks it out of the park, and obviously has got it down cold.
Well, we can use our notes for the Excel part, right?
Yes.
Yeah. It's a little cold. My hands are cold.
I know.
My hands are cold. Yeah, man.
There's just so many different things you have for rubber, there's so many different kinds of questions to do.
I heard you gave up on those. I heard you gave up on those. Your stuff smells like I figured by the time I get out of here, it'll be hot. But yeah, I stepped out this month. I was like, I should go back inside.
I haven't
Put
had
that
it.
sweater
I
on.
was so busy like
And
studying.
then the nervousness, damn, please has me walking so far.
Yeah. I was thinking about that walk like. That's
Like,
something.
you know, my hands are on what on? But it's alright.
Yeah, he said they dropped out.
We'll survive.
Ready, ready, ready.
Are we getting the answers now?
Mm-hmm.
Oh, you better
I
start
didn't
writing them
write
down.
them all with me.
Let's start writing them down.
Yeah.
Uh-oh. Yeah, I know it's too quick. Oh, this is the answers to the midterm.
Okay, what I'm giving you, these are the answers to last year's midterm, okay? So if you did what I asked you to do, to go through and try to work through those as an example, here is an opportunity to see kind of how you did and see if you've got questions about them.
I have a question on the exam. Are you gonna give like room for different rounding at different points in the question?
No room for you.
Rounding will be, trust me, it will be logical sort of rounding, okay? In the sense that if you round a couple of decimal places, you're gonna be fine.
No, no. Well, I had a few where it was like off on the chapter 4 questions, it wasn't off by much.
Number 6 doesn't make sense.